We are from Group 1 and we are going to explain and presenting about the Mudarabah contract.
Assalamualaikum warahmatullahi wabarakatuh. My name is FAUNUR BALQIS QISTINA binti Yaakob. So today me and my group mate, which is our group consists of 5 students. So we will discuss more about accounting for Mudarabah. Okay, first I will explain about the introduction based on AOIFI and also the nature and also definition. Okay, so in Islamic finance, business relationships are conducted according to standards provided by accounting and also auditing organization for Islamic financial institution, or we know as AAOIFI, in the Mudarabah standard. So the entrepreneur contributes skills or knowledge while the investor gives funds in a profit sharing agreement, we known as Mudarabah. Okay, so the purpose of Mudarabah under AAOIFI, they aims to make sure that Mudarabah transactions are fair, transparent, and also compliant with Islamic law. So it ensures that contract for Mudarabah comply with Sharia law, definition of Islamic finance. Okay, for example, for AAOIFI, number of parties for them is partnership between an investor, which is Mudarib, and also an entrepreneur, or we call as Mudarib. So compared to nature and also definition, they are a partnership between two or more parties. Okay, next about the capital management. So in under AAOIFI, the investor provides capital which is measured at the time of contract. So for nature, the capital provider provide funds for the project, and for management, the investor under AOIFI provide capital which is measured. For management, the entrepreneur manage the project. Meanwhile, for the vice versa, the manager manage the project also. And then for disclosure, AOIFI requires to disclose for any provides made for decline in the value of Mudarib asset. Meanwhile, vice versa, they does not specify any disclosure requirements.
Assalamualaikum and hi, my name is AMIRAH BALQIS binti Abdul Khalid, and now I will continue the presentation on the type of Mudarabah. So according to the Accounting and Auditing Organization for Islamic Financial Institution, AAOIFI, Sharia Standard number 13, there are two main types of Mudarabah contract, which is unrestricted Mudarabah and also restricted Mudarabah. So firstly, I will discuss about the unrestricted Mudarabah, or also known as Mudarabah Mutlaqah. In the type of Islamic finance partnership, the Mudarib or manager is granted a complete freedom to decide how the capital provided by the Rabbul Mal or the capital supplier is to be invested. The Mudarib is fully autonomous to handle and invest the funds according to their knowledge and experience to maximize the return. So for example, when an investor allocates RM1 million to a bank or an entrepreneur, or also known as Mudarib, with expertise in various investment opportunities, the investor does not impose any condition on how the funds should be utilized. The entrepreneur then decides to allocate the capital across a different sectors such as the international trade, automotive, and also the technology company based on the market condition and potential return. Next, unrestricted Mudarabah offers several advantages such as increased flexibility, more effective utilization of resources, and also diverse investment opportunity. So using this contract, the Mudarib can quickly adapt to the market changes and opportunity, potentially generating higher return. They can fully utilize their skill without restriction and ensuring optimal use of the capital. Additionally, the Mudarib also can diversify investment across the various industry and geographical locations, reducing the risk of loss and increasing the potential for profit. However, there are also some challenges for this contract, which is higher risk for the Rabbul Mal, dependence on the Mudarib expertise, and potential for poor investment decision or mismanagement. As for this contract, the Rabbul Mal face higher risk due to the Mudarib's complete control over the investment decision, which may not align with the Rabbul Mal risk tolerance or ethical preference. On the other hand, a restricted Mudarabah, also known as Mudarabah Muqayyadah, is an Islamic finance partnership where the Rabbul Mal sets specific restrictions on how the Mudarib can utilize the capital. The Mudarib is obligated to follow this guideline. The primary characteristic of restricted Mudarabah include geographical limitation, investment specific to a project, and also time-bound limitation. The Robuma specifies the industry or sector such as real estate, renewable energy, or healthcare, where the fund must be invested. Investment may be limited to a particular region, and the funds might be allocated for a specific project or venture with the set time frame. So as for example, an investor who provide RM1 million to a business manager with the restriction that the fund must be allocated to the development of eco-friendly initiative in Malaysia. So the Mudarib is prohibited from investing in non-eco-friendly venture or using this fund in other state. They must identify a suitable eco-friendly venture in Malaysia and oversee the project efficiently and provide consistent progress report to the investor. So restricted Mudarabah also offer advantages such as the risk management, targeted impact, and also aligned investment objective. So this form of contract ensure that the investment align with the Robuma's specific goal and ethical principle, enabling support for sector or region with high potential or strategic importance to the investor. However, they also challenge for the restricted contract, which is limited flexibility, increased oversight, and also potential for dispute. The Mudarib ability to adapt to market opportunity is constrained by the restriction, which may limit the overall profitability. It also requires meticulous oversight and frequent reporting to ensure compliance, potentially adding administrative burden and leading to dispute from misunderstanding or non-compliance. So in conclusion, both unrestricted and restricted Mudarabah contract have distinct advantage and challenges in Islamic finance. They cater to different investment strategy and risk tolerance. Unrestricted Mudarabah provide the Mudarib with full discretion and flexibility to maximize the reward, increasing the risk for the Rabuman. Conversely, the restricted Mudarabah ensure that investment adhere to defined objective and ethical norms set by the Rabuman, managing risk but potentially limiting flexibility and profitability. Both types require clear communication and strong management to optimize the outcome and ensure that compliant with the agreed terms.
Assalamualaikum warahmatullahi wabarakatuh. My name is KHAIRUN NAZIHAH binti Amizat, and I will continue with the next part in which about powers and duties of Mudarib. The Mudarib, who is the person managing the investment, has several important duties. First, they must work hard to meet the goals of Mudarabah contract. This means they need to put in their best effort to make the investment successful. Second, the Mudarib must ensure that the money provided by the investor is safe and will be used in ways that are allowed. They need to reassure the investor that their money is in a good hands and will be invested wisely. If the Mudarabah contract does not have specific restriction, the Mudarib has more freedom to act. The Mudarib have several key responsibilities to manage and protect the Mudarabah investment. They should invest in areas where they have the skill and where the amount of money is suitable, ensuring they can compete well. The Mudarib can do the work themselves or hire someone else if needed, such as for buying or selling goods. The Mudarib can also buy and sell on a deferred payment, which allow for more flexibility in managing the investment. With the investor permission, the Mudarib can combine a Mudarabah contract with a partnership contract. This can be done at the start or during the investment, and it can involve the Mudarib own money or funds from the third party. The person providing the money can control what the Mudarib does to protect their own interests. For example, they might say the Mudarib can only invest during a certain time in a specific country or a particular market. Moreover, the capital provider cannot directly buy or sell things or make decisions about supplies. That is the Mudarib's job. But the Mudarib has to keep the capital provider updated and get their permission for big decision. The contract also stops the capital provider from telling the Mudarib who to partner with or how to use their own money. The Mudarib is responsible for all the necessary tasks that any other similar manager would typically do. These include duties like managing assets or funds, which the Mudarib must perform without expecting any additional fee because it's considered part of their roles. Plus, the Mudarib must ensure fairness in transactions involving the Mudarabah funds. They cannot sell items for Mudarabah operation at a price lower than the common market price or buy items at a price higher than the market rate. unless doing so clearly benefit the Mudarabah. Next, the Mudarib is not allowed to use the share funds for making loans, giving gifts or donation to charity. Similarly, the Mudarib cannot give up any rights related to Mudarabah business unless the investor agrees to it. Additionally, the Mudarib can claim reasonable travel expenses, again based on what is customary and reasonable in the context of their business activities. This rule ensures that the Mudarib use the Mudarabah fund responsibly and transparently, adhering to the agreed term and standard of Islamic finance. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is NURALEEYA NATASHA binti Ahmad Zain. So we continue with the next presentation, which is recognition. So according to AAOIFI standard, which is Accounting and Auditing Organization for Islamic Financial, recognition pertains to the formal recording and reporting of financial transaction or items in financial statement. So this involves deciding when and how specific financial events are documented in financial record, influencing an entity financial position and performance. So we continue with the next presentation, which is capital contribution, recognition of capital contribution by Rabbumal. When the Rabbumal, owner of the capital, contributes capital to the Mudarabah arrangement, this capital is recognized in the financial record. So depending on the nature of the contribution, it can either be recorded as an asset like cash or receivable, and as a corresponding liability if it does not qualify as equity. So upon the receipt of the capital contribution from Rabbumal, the journal entry will be debit, cash or bank, which is asset, and this entry increase the cash or bank balance, reflecting the receipt of funds from Rabbumal. Then we credit Mudarabah payable liability. So this entry records the liability owed to Rabbumal, signifying that these funds are to be managed in the Mudarabah investment scheme. So this journal entry shows that the financial institution has received cash, which is an asset, and simultaneously has an obligation to manage these funds according to the Mudarabah agreement, which is a liability. Next is recognition of profit. In a Mudarabah agreement, profits generated from the investment are recognized as they accrue. So these profits are then distributed according to the pre-agreed ratio between the Mudarib, which is work provided, and the Rabbumal, which is owner of the capital. When profits are realized and ready to be distributed, the following journal entries are made to allocate the profit appropriately. So we have debit in Mudarabah payable, which is liability. This entry reduces the liability associated with the original capital contribute, so reflecting that the profit have been generated from the use of these funds. Then we have to credit profit share payable to Mudarib, which is liability. So this entry records the liability for the profit share that is owed to the Mudarib, acknowledging their entitlement to a portion of the profit as agreed in the Mudarabah contract. Next, we have to credit profit share payable to Rabbumal, which is equity. So this entry records to the profit share attributable to the Rabbumal, so recognizing their equity stake in the profits generated. So this journal entry reflects the distribution of profit, reducing the liability of the Mudarabah and allocating the profit to the respective parties according to their agreed upon share. So the Rabbumal share is recognized as equity since it represents their investment return, while the Mudarib share remains a liability until it paid out. So that's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. I'm NURFAKHIRAH binti Ziki, and I'll be presenting about the measurement of Mudarabah financing. So in the law of accounting and auditing organization for Islamic financial institutions, financial accounting standard number 3 of Mudarabah financing. So for the measurement of Mudarabah capital at the time of contracting, so the cash capital is measured by the amount given. The Mudarabah capital provided in the cash by the Islamic bank shall be measured by the amount paid or the amount placed under the disposition of Mudarib. Next, goods are valued at an agreed fair price. When the Mudarabah capital is provided in kind, such as trading asset or non-monetary asset, for use in the venture, it shall be measured at the fair value of the asset as agreed upon between the Islamic bank and the client. So the value difference result in profit or loss for the bank, where any differences between the fair value and the book value result from the valuation of this asset shall be recognized as profit or loss to the Islamic bank itself. Last is feasibility study cost, exclude unless agreed. The expenses incurred during the contracting procedures, such as feasibility study expenses, shall not be considered part of the Mudarabah capital unless agreed upon by both parties. Next is the measurement of Mudarabah capital after contracting at the end of a financial period. So the capital is measured as initially given minus repayments. At the end of a financial period, Mudarabah capital shall be measured as at the time of contracting with any repayment made to the Islamic bank deduct from the Mudarabah capital. The loss before work start without fault is a bank loss. If a portion of the Mudarabah capital is lost before the inception of work due to damage or other causes without misconduct or negligence by the Mudarib, such loss shall be deducted from the Mudarabah capital and treated as a loss to the Islamic bank. However, if the loss occur after the inception of work, it shall not affect the measurement of the Mudarabah capital. If there is a total capital loss in a Mudarabah without anyone's fault, the Mudarabah ends and the bank bears the loss. Should the entire Mudarabah capital be lost without misconduct or negligence by the Mudarib, the Mudarabah shall be terminated and account settled and the loss treated as the loss to the Islamic bank. The remaining capital on ending is owned to the bank, where if the Mudarabah is terminated or liquidated and the capital, including any profit or losses, is not paid to the Islamic bank upon settlement, it shall be recognized as a receivable due to the Mudarib. Next, in the law of Malaysia Financial Reporting Standard (MFRS), the measurement can be either in fair value or amortized cost. So, if it measured at fair value, gains or loss from changes in fair value are recognized in the profit or loss or other comprehensive income. This means that the changes in fair value appear in the accounting records and can affect the profit or loss for that period. If it is measured at amortized cost, on the other hand, the effective interest method is used. This method considers the changing value of money over time and any losses. It helps determine how much interest will be paid and the current value of the asset or debt. It works better for long-term investment because money value change over time. So next, I'll be presenting about the example of bank that have provide Mudarabah financing. So basically, there are some other bank that provide this service like Maybank and M-Bank, but we choose Bank Islam as for our example. Bank Islam offer a Mudarabah financing product which provide investor with Sharia compliant investment opportunities. The type of the investment is that this product operates as an unrestricted investment account which allow the bank to make investment decision without specific restriction imposed by the investor. The minimum initial investment required is 100 ringgit Malaysia, making it accessible for a wide range of investors to invest. Under this Mudarabah contract, the profit sharing ratio between the investment account holder and the bank is set at 2% for the investment account holder and 98% for the bank. So this ratio determines how the profit generated from the investment activities are distributed between the two parties, with the bank managing the capital provided by the investment account holder. So this is the example to calculate the profit of the Mudarabah financing. The daily investment balance times by the gross profit times by the profit sharing ratio times the number of days in the month divided by 365. So as we can see in the example here, the daily investment balance is 10,000 ringgit Malaysia times 3% of the gross rate times 2% of the investment account holder profit sharing times 30 days divided by 365 days, and the profit will be 0.49 ringgit Malaysia. So that's it from me. I will pass to the next presenter.
Okay, thank you to the previous presenter. Now I will explain about recommendation. First, Mudarabah capital can be measured more accurately and profitably if the share of Mudarabah income and also losses of Islamic banks is recognized. So when an Islamic bank provides Mudarabah capital in cash, it should be measured by the amount of paid or put under the Mudarib's disposition. So according to AAYFI, when an Islamic bank provides Mudarabah capital in kind, like trading asset, it should be measured by the asset's fair value with any difference between book value and also fair value, recognized as profit loss to the Islamic bank. Okay, next, the second recommendation is the repayment of the Mudarabah capital by Islamic banks will be deducted from the Mudarabah capital. So if part of the Mudarabah capital is lost before the work begins due to damage or other circumstances without any fault or negligence on the part of the Mudarib, so this loss will be deducted from the Mudarabah capital and will consider as a loss to the Islamic bank. Okay, the third recommendation I will provide here is, so regarding to AAYFI Financial Reporting Standard, the Islamic banks and Mudarabah portion of income or loss is recognized in the following manner. So at the time of liquidation, the profit or loss related to portion of the Islamic bank mudarabah financing transaction that begins at the end in the financial quarter must be recorded. Okay, the last recommendation here. So in Islamic finance, full disclosure is required for accounting process related to mudarabah transaction to maintain Sharia compliance and also transparency. So financial statement must generally clearly outline the responsibility of entrepreneurs and also financiers, agreed profit sharing ratios or any management fees or profit sharing agreement, and also this distribution of profit and also losses to comply with the disclosure standards. Okay, next I will explain more the last part, which is conclusion. So the recognition and also measurement of mudarabah, capital and also income or loss is made transparent and also consistent by these guidelines. So according to accounting standard AA or IFI, mudarabah capital provided in cash should be valued according to the amount paid or disposed by the mudarib, while assets in goods are valued according to their fair market value. So the difference between these two values is recorded as profit or loss to the Islamic bank. I think that's all our opinion based on this case study, accounting for mudarabah. Thank you.